Hey there, Brad Castor from GreatOptionTradingStrategies.com. After I graduated high school, I did some janitorial contract work while I bummed around a local community college for a year or two. I had my regular accounts during the week, but one Friday afternoon, my boss calls me up and asks if I could help out the window cleaning crew over the weekend who were scheduled to do the windows on a 2-story building. I told her that I really didn't like heights of any kind. Oh, it's super easy, she assured me. They're short-staffed and just need a ground person to mix up the cleaning solution and hand it to them on the scaffolding. I fell for it, of course. When I arrived Saturday morning and introduced myself to the crew and told them I was their ground person, the lead window washer got this puzzled look on his face as he asked me, "What's a ground person?" Now, when it comes to selling puts or covered calls for income, an issue that sometimes comes up is why stick with the losing trade? My response is like that of that lead window washer from all those years ago. What's a losing trade? I'm 100% serious. If you're selling options for income, the idea of a losing trade should feel as out of place as a ground person washing windows on a building with more than one floor. Not because these trades never go wrong, but rather that they're almost always repairable, as long as you don't screw up some part of the process by over-leveraging, selling your options near a top, or trading on an unprofitable business whose stock is on its way to zero. More specifically, in today's video, I'm going to explain the 3 reasons why I stick with so-called losing trades. But before we get started, a little background. I've been trading options, mostly selling them, since 2002. I launched the Great Option Trading Strategies website way back in 2008, where over the last 17 years I put together a ton of resources, free downloadable guides, ebooks, special reports, case studies, etc., and nearly 300 articles on all aspects of selling options for income, as well as incorporating options into value investing and or dividend growth portfolios to further stack the deck in your favor. And 13 years ago, I started my private option trading membership site, the Leveraged Investing Club. Not currently accepting new members, so no worries about a sales pitch here. But if anything we covered today resonates with you, you might want to check out the Great Option Trading Strategies website and all the resources available to you over there. I've added links to the site and the free downloadable library page in the description below, and I've also pinned a direct link to my daily option tips and insights newsletter sign-up page in the comments section. At the end of the day, wealth is about one thing. How much sustainable income can you generate from your capital? And as someone who's been trading options for nearly 25 years, I can tell you that options are the ultimate income vehicle because they can generate very high annualized income, and they're also extremely flexible and forgiving once you learn how to exploit their inherent advantages. I call this heads we win, tails Mr. Market loses. And it's true. If you're an option seller, you can structure and manage your trades so that at the end of the day, you should almost always come out ahead, even if you're completely wrong, as I've been many times on trades myself. That's what this channel is about. It's what my daily tips newsletter is about, and it's what the Great Option Trading Strategies website has always been about. So let's dive into today's topic. Why stick with a losing put selling trade? First, cutting losses early is much easier said than done. By the time you realize you have a problem, and presumably that would be if the stock trades below the strike price of the put you've sold or written, bailing on the trade isn't going to result in just a small loss. You're going to lock in losses that are a multiple of whatever premium you collected when setting up the trade. I'll give you a great example, and a recent one too. So back on July 21st, 2025, with Chewy trading at $38.60 a share, inside the Leveraged Investing Club, we sold August 15th, 37.50 puts for 89 cents a contract. Now, I'd been watching the stock since it fell apart following its earnings release back in early to mid-June and thought, mistakenly it's turned out so far, that the stock had bottomed and found lasting support in the 37 to 37.50 share price range. It was pretty much holding that support until last Friday, July 25th, when shares traded lower by 2.5% and ended the day at $36.31 a share. So, the first 4 days of the trade, everything was going according to plan, and then on the 5th day, the position finds itself in the money a bit. Technically, this is now a losing trade. So, should have I bailed on it? Well, check this out. The closing bid-ask quote on Friday the 25th for the Chewy August 15, 37.50 puts was $1.75 to $1.90. So best case scenario, it would probably cost me $1.85 to exit the trade. Now, remember, I received 89 cents a contract for selling the put just 5 days earlier. So it would actually cost me more than twice the amount I received if I wanted out of this so-called losing trade. But I would avoid a bigger potential loss by bailing early, right? Maybe, maybe not. We'll see about that and address that issue in a second. But let's look at the hidden costs that you're really incurring when you exit an underwater put selling trade just because it's underwater. To smooth out the numbers a bit and make it easier to follow, let's just say I collected 90 cents a contract when I sold the put, and then the stock moves lower on me, I get scared, and buy to close my short put for $1.85 a contract. Great, I've just booked an overall loss of 95 cents a contract. That means, just to break even, I now have to find another comparable trade and hope like hell this one works out perfectly so that I'm able to bank my full returns on trade number 2. And if I want to be net profitable, actually have a positive return in my account, I now need 2 winning trades in a row to go off without a hitch. Also, keep in mind that this is a tame example since the position is currently only a little in the money. What if Chewy was trading at $35 a share, $34, $33? If I were to lock in losses at those levels, I might now need 5 to 10 winning trades in a row just to break even. Bottom line, if you're routinely booking losses on option selling trades because you think it's important to cut your loser short, you're probably not going to have a lot of long-term success, or short-term success for that matter. The second reason why I stick with so-called losing trades is very simple. Why accept a loss if you don't have to? This goes back to my concept of option selling as a customized trading approach that becomes heads we win, tails Mr. Market loses. I'm serious. When you learn what an attractive put selling setup looks like, and when you learn to properly size your trades, and when you learn how to optimize the management of your trades, actual losses should be very rare. These trades are so flexible and forgiving that losses become nearly non-existent. We have a roughly 98% winning percentage inside the Leveraged Investing Club. Not because I'm right 98% of the time. Not even close. It's because I've learned how to repair just about any put selling trade that goes the wrong way on me. Last month I posted a video making money on bad put selling trades that detailed 4 real world trades we've closed this year where the underlying stocks fell anywhere from 35 to 50% on us. And yet we still walked away with realized profits on all of them. The final returns range from 8.62% annualized over 138 days to 19.43% annualized over 85 days. I'll post a link to that video at the end of this one. It's definitely worth checking out because when you discover that you can make these kinds of positive returns on bad trades, it really is a game changer. And after you've successfully repaired a few in-the-money short put trades and after you understand the mathematical principles involved, the process gets less scary or mysterious. And then you look back on all those unnecessary losses you've taken in the past. It's like your car getting a flat tire and you say, well, this piece of crap is no longer drivable. Time to get a new ride. The third reason I don't exit a losing put selling trade or a covered call for income trade is that when I talk about repair or renegotiation or rehabilitation of an underwater trade, I'm not simply talking about getting back to break even. I'm talking about actually booking final profits that still almost always end up in the okay to decent range. And by that I mean somewhere in the upper single digit to lower double digit annualized range. But it's not uncommon for repaired trades to do even better than that. I mentioned those 4 bad trades where the stocks in question really sold off on us and only partially came back. The worst performing trade was Dell, and that still resulted in an 8.62% annualized ROI over 138 days. The other trades included a Signet Jewelry covered call position that resulted in 12.41% annualized gains over 186 days, a Celsius Holdings put selling trade that resulted in 17.04% annualized gains over 248 days, and an ELF put selling trade that resulted in 19.43% annualized gains over 85 days. Those last 2 trades had solid numbers even for a winning trade, let alone ones that had to be repaired. But I would say that the first 2 trades are more typical of what a trade repair campaign looks like in terms of the final returns. So why would you willingly take a loss in a trade when you can learn how to manage a trade so that you still end up with respectable and solid gains? The only reasons I can come up with is you either don't know this is even possible or that maybe you just don't like money. Now, I don't want to make straw man arguments here. If I'm saying 98% of put selling trades are winnable, what about the 2% that aren't? It's actually pretty simple. losses occur because there was some kind of breakdown in the process. When it comes to individuals' personal trades, the biggest self-sabotaging mistakes I see folks make are over-leveraging a position or expanding a trade, which we sometimes do, but only under very specific circumstances, too quickly. Those are actually related, as expanding a trade too early can quickly lead to over-leveraging or the inability to make bigger strike price adjustments later. And over-leveraging can take two forms. One, at the trade level where the position size becomes too large, or more likely started too large, to safely or effectively repair it. But over-leveraging can also be at the portfolio level where you simply have too many open positions to effectively repair them if there's a market-wide event. Now, in terms of club trades that resulted in actual booked losses, those really had nothing to do with position sizes or contract expansion. On a couple of occasions, it was about a rapid fundamental deterioration of an underlying business. Case in point, in the post-COVID era, we incurred significant losses on Stitch Fix and Big Lots. Now, one of the principles we follow inside the club when it comes to the trade selection process is to avoid selling puts on any stock whose underlying business is unprofitable. That's because we take a value investing approach and never sell puts on a stock anywhere near a top. And as long as the underlying business remains profitable, it's mathematically impossible for the stock to trade down to zero. Therefore, any trade entered under those circumstances should be repairable, unless some other form of self-sabotage takes place along the way. Both Stitch Fix and Big Lots were profitable when we entered those trades, especially Big Lots. Stitch Fix, it turned out, was only briefly profitable. But regardless, both businesses deteriorated horribly. Big Lots went bankrupt and Stitch Fix is still circling the drain. So in hindsight, sure, I totally wish I would have bailed on both those trades much earlier in the process. Now, I'll let you be the judge whether this is a good quality or a bad quality, but I'm almost always willing to fight to the death to repair a trade. Although most trade repairs aren't that dramatic. Most trade repairs are just simple math problems. But we've also repaired so many trades that were really crazy, where a stock may have dropped 50, 60, 70, 80%, which should have resulted in big losses, and yet we still walk away with more money than we started with. We actually sold puts on SPR, the airline manufacturer and Boeing spinoff, when I felt that the 737 MAX was about to be recertified. It wasn't. And the timing couldn't have been worse. It was right before COVID. Even though the stock was already down a lot when we entered the trade, it still fell another 80% on us after that. But we used every trick in the book we had and fought Mr. Market to a small $243.97 overall loss. Technically, we could have kept fighting until we reached profitability, but at that point, after everything we'd been through, I considered that to be close enough and a major victory. Most of our other very few losses have also been pretty minor. I remember we were in a Papa John's trade back in 2018 when the company's founder was blowing up the stock with some very tone-deaf racial comments. And eventually the situation just became too chaotic to get a read on where the hell the stock was going to be trading at any moment. There was this weird dynamic where the worse the company was perceived to be doing, the more the stock would rally in anticipation of it having to go private. So we bailed on that one for a loss. That was actually a bear call spread, which we occasionally trade inside the club, and I tend to keep those on a tighter leash anyway. Okay, to wrap up, I'm not trying to sugarcoat anything or make straw man arguments, but my practice is to stick with so-called losing put-selling trades for three simple but powerful reasons. Number one, bailing on an underwater trade is easier said than done and will result in losses that may be multiple times larger than the premium you collected when setting up the trade. Number two, if you get the selection, setup, and management process right, virtually every put-selling trade will be repairable. So why accept an unnecessary loss? And number three, repairing trade isn't simply about breaking even. It's about still posting, in most cases, solid to even very good returns when the dust finally settles. Really let that sink in. If you can take losses off the table, you're no longer working with this trading paradigm of winning trades versus losing trades. You're basically running your own income-producing business. Okay, would love to hear your feedback, questions, etc. Or if there's some other part of this process you'd like me to cover, let me know in the comments below. And if you enjoyed this and want more, be sure to check out the other channel's videos and playlists. I took some time off from YouTube, as in a few years, but I'm adding new content on a regular basis now, and those videos are starting to add up. Also, sign up for the Daily Tips newsletter via the pinned comment below. Options are the ultimate high-yield income vehicle, and they can be structured in so many different ways to generate sustainable and safe high-yield income. The Daily Tips newsletter is a perfect complement to this channel because I can cover more topics and sometimes deeper in written form versus video form. You can sign up directly, or there's also a link in the description section below to the Great Option Trading Strategies downloadable library page. Download anything from there and you'll also begin receiving the Daily Tips newsletter automatically. Heads we win, tails Mr. Market loses. That means you should be coming out ahead on virtually all of your trades. Okay, until next time.